And so when it comes to the compounder curve, where would I put IBM? Given all the facts and information that we know today. Well, how's it going, friends and family? International Business Machines, ticker symbol IBM. Dude, right now, they're selling off. If we zoom out the past 30 business days, negative 15% in the red. And even today, they're in the red. Some people think that this is a buying opportunity. And most people, they don't agree with that. They think it's a falling knife. So if we take a look at year to date, it's in a downward trend. I mean, they were roughly at about what, $306, and then in June, roughly $332 a share. So why are they falling off so hard? In this video, I'm going to be breaking down my full analysis on IBM, and more importantly, what I think the fair value estimate should be. Like, what should IBM be trading for, predicated upon their numbers, fundamentals, and data, not just my gut feeling and what I think. No, we're going to allow the empirical objective data to speak for itself. And just please do keep in mind, okay, please, just because I'm sharing my homework with you, it does not mean that I endorse or recommend the stock. Okay? That sounds good with you. Let's go ahead and get into it.
Stocks that compound and dividends, please. Welcome to investing with a side of cheese, where balance sheets matter and cash flows get fatter. But hey, I'm not a financial advisor.
First, let's take a step back and answer the question, what exactly is IBM and how do they make revenue? So IBM is a tech conglomerate that operates all around the world, and believe it or not, they used to be the original Mag 7 from back in the day, and in the past, they made a bulk of their money from selling physical computers, servers, and almost everything in a corporate office. Now it's different because their business model, pretty interesting. It's almost fully integrated from start to finish. Once you partner with IBM, dude, you're pretty much sealed. Your fate is done. So IBM, they sell the physical platform, and their own software powers that platform, and they're trained consultants on site or through Zoom meetings. They integrate it into your business workflow. So breaking it down even further, software as a service, it makes up 45% of their revenue. The big dogs in this category include Red Hat, and Red Hat, it builds its own commercial enterprise operating system on top of Linux. So in a way, IBM competes with Windows, Microsoft, and Apple's Mac OS. Another software application in their portfolio is Watson X. It's the flagship one they're trying to pump, and that's their future, which allows enterprises to build and deploy artificial intelligence while keeping sensitive data under their own control. Because think about it, not every organization wants to hand over sensitive information to OpenAI or Gemini or language learning model. Some of that stuff you want to keep in-house. And then consulting makes up 32% of their revenue. And from my understanding of the landscape, obviously I'm an outsider looking in, they have two categories of consultants. Number one, the technical consultants that help troubleshoot issues and help clear stuff up. And then number two, boots on the ground, or I guess nowadays it's Zoom meetings, change management consultants that help your team get trained up to speed on IBM gear, equipment, infrastructure, stuff like that. And then hardware and infrastructure sales, 22% of the top line. This includes their mainframes and the power servers. And then last but not least, less than 1%, miscellaneous licensing and financing fees. Sometimes they do in-house loans to their customers. And from my understanding, the entire financial system in Wall Street, not really, but almost, right? It runs on IBM's products. Just to prove a point on how sticky they are. And now let's go ahead and talk about the recent developments surrounding IBM. I'm filming this video at 8 a.m. and they're scheduled to report their earnings at 5 p.m. later today. But having said that, we already got a preview of what their earnings is going to be like. So leading up to me researching, analyzing IBM and making this video, I mean, we just witnessed IBM, they're selling off. They might even hit $199 a share before the end of July. So why did Wall Street and retail investors punish them so harshly? Well, it's kind of scary, right? IBM is warning that companies are panic buying servers, storage, like SSD, RAM, and memory right now before the supply shortages hit, because they're saying it's going to get a lot worse than it is right now. Instead of buying and procuring IBM hardware at the anticipated refresh cycle timeline. So if you want to understand IBM, this is really important. I had to read through their 10K to truly understand their business model. You have to take into account IBM's mainframe business. Remember earlier we talked about it's part of their physical hardware sales. So you can think of mainframes as the heavy-duty back-end servers running almost the entire world's major banks, financial institutions, airlines, all of the old blue chip industry. Maybe not so much the tech space, but needless to say, they're an absolute money printer, the mainframes. And about every 3 years, I just hinted at it, right? The refresh cycle. Their customers upgrade to the latest generation of hardware. I mean, think about you and your kids or your wife. They're not happy with that iPad that they got 5 years ago. They always want to replace and refresh it to have the latest and the greatest. Companies in the Fortune 500, exact same logic. And in between the customers refreshing their hardware, IBM collects a steady stream of software and maintenance revenue. So in my humble opinion, it's a pretty boring business, but it prints cash. Except this time around, Wall Street, they were anticipating that IBM was going to be printing cash for this quarter, which they're going to report in the next 8 hours or so. But it's not going to be the case. It's going to be a pretty hideous earnings. Now, this might be me reading between the lines. When IBM says that some customers are delaying upgrading their hardware, I don't think that's necessarily a sign that they're abandoning the platform and saying, okay, we're done. We're severing our relationship with IBM. Instead, to me, it sounds more like the companies are juggling budgets and spending priorities in a really fickle economy. In one hand, I think things are bullish. And on the other, the economy itself, it points that we're headed towards a recession. So I think there's a lot of hesitation with the FP&A and strategy departments of most companies in the S&P 500. Because at the end of the day, most financially responsible businesses, they only have a finite budget for what they can spend on IT, cloud, and tech upgrades. And so what's happening right now, these companies, if they front load and buy memory and storage and whatnot, they can't just magically get money out of thin air to pay for IBM's hardware, even though they usually refresh it every 2 to 3 years. So they might push it back 1 quarter, maybe 2, or indefinitely, right? That's also a possibility. So in short, IBM is selling off because of their terrible and disgusting earnings, missing their top and bottom line expectations. You can't do that as a blue chip company. If you do that, you are going to get punished. But to the severity of dropping from 330 all the way down to 200, a 26% slap in the face. Look, I'm not trying to come across as biased, but I feel like that was way too harsh, way too severe. It's like you getting a speeding ticket and the sentence is you getting your limbs chopped off as a consequence. It's like, what? Why not just give them a ticket? Like a 5 or 6% drop in the red? I mean, that's understandable, but 26, I mean, they lost nearly a third of their market cap on a single trading day. But anyways, let's go ahead and transition into the cheese situation. What are the 3 big considerations when it comes to IBM? Number 1, I have labeled as the cloud glue. What do I mean by that? So when you think about big operations in the S&P 500, your favorite publicly traded stock, whatever, for the most part, if they have 10,000, 20,000, or even 100,000 employees, they usually do not use just one cloud provider for everything. Because when you think about it, that's incredibly risky and awfully expensive. And so in practical terms, a company in question, they might allocate certain data or departments to Google Cloud. They might store some applications on AWS and operational workflow, emails, and Office suite for Microsoft's Azure. So spread it across. That way, if one thing goes down or gets hacked or a data server in the Middle East gets blown up, at least you can still kind of operate as a business. But on the other side of that spectrum, when you spread all of your work, your data, your information, and project management tools across all these various different cloud servers and providers, it gets a little messy. And that's where IBM's Red Hat comes into the situation, because it gives these businesses a standardized way to build, deploy, and manage that software across all of those environments instead of having to treat each one separately, a universal line of truth. And I think as more and more companies migrate to the cloud, I think the value proposition that IBM provides in simplifying the life of that random project manager or Betty in HR, it's good. And then the second point that I want to make about IBM, I have labeled as decreasing CapEx, capital expenditures, or I guess cash that a company is spending on physical infrastructure to increase or to improve their operations, like building out one more factory or buying more trucks to increase the amount of deliveries you can do, or in the case of the hyperscalers like Meta, Microsoft, Google, building out physical data centers. Well, for IBM, unlike other big tech in which their free cash flow is just melting away, their free cash flow situation is really healthy, smooth, and is stable. And then consideration number 3, I have labeled as the patent library. So I did some research on Blind, which is kind of like a workplace social media, except everyone is anonymous, where you can talk trash about your department or supervisor. You can also share confidential information about your compensation. It's an interesting platform. One IBM employee described his company as a patent library that occasionally does some technology. Because when you think about it, IBM, no shortage of innovation. You take a look at their track record and their history, they literally used to be the pioneers. They were the Microsoft, the Amazon, and the Googles in the 80s and the 90s. But like most things in life, what made you so special when you were nimble and lean and you were able to make decisions quickly without having to get approval from 5 different managers? Eventually, when a company gets bigger and bigger, gets mature and established, it gets a lot more bureaucratic. And given my own experience in corporate America at 2 different Fortune 20 companies, red tape, it sucks. Because what should only take like 30 minutes to get a blessing for your project or your decision so you can carry on could take weeks. And it's really annoying, but it makes sense. Because once you get really big, you got to be careful with your decision making because there's consequences and ramifications across different departments or to the consumers and the customers. But with IBM, it's at another level where it's really, really annoying and frustrating as an employee. However, innovation, it's in their DNA. As a matter of fact, they claimed over 150,000 US patents from 1993 to 2023. They kind of remind me of 3M in that they have patents for the most random stuff in the world, and they collect royalty fees and licensing fees from anyone else that wants to use their technology. Like 3M and Velcro. I mean, just the other day, I think it was Monday or was it Tuesday, 3M reported their earnings and they jumped up 10 or 12% in the green. Now, I'm not trying to ruffle up some feathers or blow up your toilet after eating some Taco Bell with some sketchy lettuce. However, from my understanding, a lot of people do not like IBM because of their reputation of horrible, atrocious management. From middle management all the way to the top, people are not a fan of the way the ship is being led. For instance, I'm really bullish on Red Hat. Not too long ago, IBM spent billions of dollars to acquire them. And that's what they usually do. IBM buys really phenomenal companies with a bright future like Red Hat, and then slowly kills and crushes and gets rid of their culture and introduces that IBM red tape. As a former guy on the strategy team, I'm going to tell you right now, that's one of the most difficult things to execute. Like when you buy out and acquire a smaller company, one of your competitors, and you integrate them into your business, changing their way of thinking so that they can fit the SOPs for your established organization is harder than you think. And that's why when you look at the M&A, especially for the P&L, sometimes they take a huge one-time hit to just fire everyone and give them a severance so you can start with a clean slate. Like you'll keep the highly talented folks, but the ones that are just bloat or I guess quote unquote fat, sorry if that's not kosher, they just get rid of them and they just bring new people in or transition some people from the existing organization to that new one. But I'll tell you right now, getting rid of everyone and starting with a clean slate, I think that's a horrible decision because what made them so unique and special and their evidence growth is because of their people. And if you get rid of them, I feel like that's kind of stupid. And my whole thinking is there's a lot of value add that they can bring to the table to introduce new ideas, strategies, and avenues of doing things. And you might be able to think outside of the box. And that's why when Target announced their transition of leadership at the beginning of the year, I think it was in January, maybe at the end of December, I wasn't a fan. Because essentially, their chief operating officer that was with the company for like 25 or 30 years, he became the CEO. And I kept talking about how Target's leadership for the past 7 years, no bueno. Because how dare they bless off on the decision to flip-flop the political aisle with their marketing and their merchandise? But I digress. I think a better approach for Target would have been to headhunt and hire an executive officer from Walmart or even Amazon, just to bring a new taste, a new flavor, a new approach. Because when you bring someone internally, the only way they know how to do things is the way it's always been. Because how do you think he became a chief operating officer? By nodding his head and clapping to the ideas of whatever the CEO was saying previously. That's why for Target, not really happy, but the stock has been turning around, contrary to what I just said, so whatever. But getting back to the video in IBM, another reason why a lot of the workers are not really happy with the executive leadership team is that they've been laser focused on reducing overhead costs. If you open up the P&L, the income statement, one of the biggest drivers of eating away at profits is the SG&A, how much you compensate your workers. And so to reduce costs, I mean, this is not unique just to IBM. I think a lot of the Fortune 500 companies are moving in this direction. They're offshoring and shifting a lot of the jobs to places like India, the Philippines, while at the same time getting rid of American workers. And I completely understand why that rubs people the wrong way. Next, we're going to talk about IBM's report card predicated upon their financials and their numbers. And the first one is in the category of financial performance. This is going to be based on their P&L, their margins, the consistency of the numbers that they execute, share buybacks, and all of that jazz. Since fiscal year of 2020, the growth in the top line has been slow, but in recent years, it's been ramping up. And something else that you'll notice is from fiscal year 2018 to 2019, you'll notice there was a huge drop off in their revenue. And I looked into it and I found out that's when IBM divested Kyndryl, which is now their own publicly traded company, and their numbers got deleted from IBM's P&L. So you got to read between the lines. It's not because IBM suffered and they were doing worse. It's because the money associated with Kyndryl was gone. And that's something else you'll notice with IBM. Sometimes the revenue will grow by a huge amount, and other times it'll shrink a lot, and you got to look into why. And that's because it's a company that loves to do acquisitions and to swallow up the smaller fish in the sea. If there's any potential in a company, they'll go ahead and just buy them out because IBM, they have more than enough money. So when you think about the revenue situation for IBM, When you see big growth in the numbers, for the most part, it's because of inorganic growth from those new companies and their numbers they've been executing, getting copy and pasted onto the P&L. For me, that's okay. I think inorganic growth is not too bad, as long as your remaining lines of business are still doing well. Like if they're shrinking and your acquisitions are the only reason why your top line looks like it's growing, then of course that's bad. But if the old business is okay and the new ones add on top of it and it looks great, it's not bad. I mean, Procter and Gamble, it's an example of a company that loves to do acquisitions, and I don't think it's the worst thing in the world. But the cool thing about IBM, they actually make fundamentally sound, really good decisions on what companies to swallow up. Like in the past handful of years, this includes Red Hat and HashiCorp. Another variable as to why their revenue might not be so smooth and steady is because the hardware refresh cycle is not every 12 weeks. Okay, sometimes it's every 2 years, sometimes every 5 years, shakes out to roughly 3.5 years, according to their own 10K. And when we talk about the profitability of the business, every single one of their margins are trending in the right direction, but we kind of understand why that is now because of offshoring the talent and the labor, but also because they're making this pivot from being strictly hardware to more so software. Something that's not good about IBM, that's not exclusive just to them, I think other tech companies do this as well, they're guilty. They've been diluting their shareholders since 2020. But to make up for that, their ROIC, which as you guys should know is the most important metric that I care about in a company, the return on invested capital, is more than double their weighted average cost of capital. So in other words, how efficiently they're utilizing the capital from taking on loans, from issuing shares versus the cost of doing business. So their return on invested capital is roughly 15%, and their weighted average cost of capital, 7%. That's superior. Like that's in that S tier caliber to execute those kind of numbers. My only real knock against IBM is the consistency of their earnings or lack thereof. I know I say that phrase all the time, but for IBM, it's truly the case. It's up and down like waves. It's not a smooth and steady ship because of the M&A activities. Because when you buy out a company or divest a company, there's a crap ton of one-time fees and money that goes out your kahoo. Talking about lawyer fees, investment banking fees, severance costs, legal fees. There's a lot that goes into it and it shows up on the P&L. And that's why I think for IBM, I think it's really important to look at the free cash flow per share instead of their EPS. It's a really good proxy. And the free cash flow per share, stable. So all in all, I think for IBM, their financial performance, C, maybe a C plus. Now, this is based on a grading scale here in the US. It goes from A all the way down to an F. F, terrible. And A is really good. I don't think I've ever given a company anything in the S tier, although if I were to do the next category, which is the balance sheet, when we think about Cal-Maine, I would give them an S. It's probably one of the cleanest balance sheets that I have seen in the past 6 months. When it comes to IBM, their balance sheet is pretty healthy, all things considered. However, their debt situation has been getting worse and worse since 2021. And to see if they're truly drowning in debt, I like to look at the debt to EBITDA ratio. And that as well tells us that it's still a little too high. But comparing IBM to their own history, yes, it is lower than usual, but still, I think it is a yellow flag because it's a 3.8. The debt to EBITDA should be at around a 3 or lower, especially for a mature established conglomerate like IBM. To be at a 3.8, I'm not a fan of that. And so their books are a little concerning, to be frank. For reference, on the other end of that spectrum, SAP, that's a peer to IBM, their debt to EBITDA is a 0.6. So it goes to show that you don't necessarily need to be drowning in debt like IBM. So consequently, I think a D plus. And then the next category is their dividend safety. Their dividend profile on surface view, I think it's pretty juicy for a tech giant. It kind of reminds me of Cisco. They also have a pretty good dividend profile because the yield is at least 3 point whatever percent. Not bad at all, especially taking into account it's a sustainable payout, meaning they're not going to suffer in order to finance that dividend to the shareholders. But the growth rate, not existent, not a fan of that. I would rather see like a 2.5% dividend yield and the company be growing it at a rate of 10 to 12% year over year rather than seeing a 3% with no growth. But I think it makes sense. And that's because their EPS on paper, it fluctuates so wildly that they can't really forecast a stable 10% growth rate. And that's why when I see a company able to execute 10, 12 or 13% growth in their dividend year over year, it shows confidence from the management team like, dude, we're crushing so hard. We know for a fact that we can continue growing it at this rate because our EPS is growing at 25. 40%. Then again, their free cash flow per share, really remarkable. So I don't see IBM cutting their dividend anytime soon, but I also can't see them growing it at a rate of like 8 or 9% anytime soon as well. So I think all things considered, a C plus. And then last but not least, when it comes to the valuation of IBM, their average PE ratio for the past 20 years, 27.5. And when you take into account only the past 5 years, then it's a 35.1. And right now, friends and family, at the time of making this video, IBM's trading multiple is an 18.6. So on paper, based on their own timeline and them racing against themselves, they're undervalued on paper. But we can't say that for sure unless we figure out their inherent worth. So their valuation, a B minus, and that's what we're going to do next. So the fair value estimate for IBM based on the GARP formula, growth at a reasonable price, if their revenue grows at a rate of 4% year over year, then IBM should be $186.50. But between you and me, that's pretty bearish and negative thinking. So if we bump up the number a little bit and say, and bake in 7% growth in their revenue, then IBM on paper should be $247.85. However, the reality is IBM, their top line has been growing at a rate of about 9 point whatever percent. So if they do that again and it's back to back, and we say 9.5%, then on paper, IBM should be $312.23. But I think that's looking at things from a rose-tinted glasses, like, oh my gosh, it's so pretty. Have you heard the term of like beer goggles, where it distorts your reality and perception of things? I don't want to think too optimistically, but at the same time, I don't want to be too negative. So we'll just meet in the middle and say something like the 247.85. So on paper right now, the upside from their current trading price of about 210 to 247, not bad. And according to the DCF model with a discount rate of 7%, then IBM should be 273.69. So the GARP formula and DCF, not too far off from one another. And then last but not least, as a sanity check, the Benjamin Graham's valuation spits out $228.65. So no matter how you look at it, according to 3 different inherent worth calculators, IBM, they're undervalued. But it's not like a huge margin where it's like they should be $450 a share and they're currently $210. They're just slightly off the mark. And to support the idea that IBM is undervalued, looking at their trading multiple history also says they might be. So on paper, IBM is undervalued, but it does not mean or guarantee that the market will agree with me, because I've seen it time and time again. Even though a company might be undervalued, they could continue selling off and go further into the red. And that's just the reality of the stock market. You would hope that it would be rational, that it would use logic and be like, you know what, this company, it is undervalued, so let's pump up their stock price so it's more in line with how much they truly should be. But that's just not the case. And other times, there are companies and their stock price where it's detached from reality, like their fair value should be like $100 and they're currently trading for $900. As soon as I said that, I know some of you listening to this or watching this, you immediately thought of that company. I'm not going to say which one because I don't want to step on any toes. So thinking about the valuation gap, they're currently $210. Their inherent worth should be $250 a share. So if I were to go gung-ho and buy IBM right now, the upside until they hit their inherent worth price, 19%. And so if I already made up my mind and I said I'm going to buy IBM, what would be a good price? I think with the dollar cost averaging framework, because I'm not the kind of guy that goes gung ho, lump sum all at once, because what happens if the stock price goes lower? Then you've ran out of gunpowder and cash, your position is gone. You can't buy more. So I like to slowly nibble away and accumulate shares as the share price of a company that I'm really interested in goes deeper into the red or trades sideways rather than going all in at once. If I was an individual that was infatuated with IBM and I know stuff that the public does not and I'm bullish and I really had to get them today, a good price, 200. A bargain price, 185. And I think a steal of a price where even if you're bearish about IBM, even you might be questioning things. You might back up the truck to load up at 150 a share because IBM has a weird trading history where they'll jump up to like 290, 300 plus a share and then sell right back off to 240, 250. So to get them at around 150 and try to sell them at 300, that's a 100% upside. And so when it comes to the compounder curve, where would I put IBM? Given all the facts and information that we know today. And what you see on your screen right now, in the past 8 to 10 months, are all of the different companies that we have analyzed on this channel. And it's based on how good is this business? Are they going to be a certified compounder and be placed into the S and the A tier? Meaning they're going to significantly outperform the market. If they go into the C bucket, that means their CAGR and performance might rival that of the S&P 500 once you average it out. And then of course the F tier, I would say the CAGR graveyard. By putting your money into Big Bear or Chime Finance or Carter's Baby Clothes, probably not the wisest utilization of your capital. But before I place IBM into the D tier, no, I'm just kidding. A topic that we didn't really touch upon or talk about is IBM's role in quantum computing, which we discussed in the next Intel government-funded stock video. I go into a deeper dive in that one if you're curious. Fun facts, as of right now, IBM is pound for pound the global leader in quantum computing. Whether it pans out to be commercially lucrative or a money trap, that's the big question. We do not know. Some people say, oh, that technology from being viable and useful is another 5 years away. Some people think it's another 20 to 30 years. And if you are lazy bones and you don't want to watch that video in one sentence, I'll summarize it like this. Quantum computing is essentially a computer on steroids for problem solving. So if you think what we're able to do with AI right now is remarkable, from what I understand, quantum computing is essentially Captain America once he hops on the steroids. As a matter of fact, IBM, they received $1 billion from the United States government in order to launch Anduril, to be America's first dedicated factory for quantum computer chips. Something that's really silly about IBM is they used to develop and manufacture a lot of semiconductor chips. But they got rid of that business and sold it off to global foundries, which I think was a terrible decision in hindsight. But that's neither here or there. And something else is the military created a $151 billion budget pool for missile defense technology over the next decade, because the current party in power, they're pretty gung-ho about the Gold Dome or Iron Dome or whatever it is, the air defense artillery system. And in relation to that, IBM's goal is to try to have Watson X to be the software brain behind those defense systems. And so I guess the point that I'm trying to get at is, if the United States government has skin in the game and they put their own money in you, they're probably going to do whatever it takes to see you succeed and thrive. I mean, I'm truly not a fan of Boeing, but because the government has their money invested in Boeing, they always seem to find a way to thrive, just like with GM, just like with the big banks during their bailout during the Great Recession. Then again, we have to take into account what I just said. Those are moonshot bets, because quantum computing and the whole missile defense software thing might not pan out. But even if it doesn't, you still have the boring, tried and true business model underneath it all, and it prints cash. So long-winded way for me to say when it comes to IBM, I think, now this might be unpopular, I think IBM is a C plus. Just missed the mark of being in the B tier. I truly do not think they should be in the same ranks as like Oshkosh or United Health or Texas Instruments. I think a case could be made that they're similar to Oracle right here in the B tier, but I think it's slightly less attractive because for different reasons, I think Oracle I'm more bullish about because if OpenAI turns out to be the biggest winner in AI, or if TikTok becomes even bigger than they are right now, then Oracle is going to benefit from that. Now, on the other hand, if quantum computing in the year, I don't know, 2035 or 2045 turns out to be a game changer, then IBM obviously, it's a slap in the face for them to be in the C bucket. They should be in the A tier, but we do not know. And I think another reason why I had trouble placing IBM into the B bucket is because of their stock market performance. Now, the orange line depicts IBM, and the blue line portrays the S&P 500 represented by the ETF VU. Now, if we zoom out 1 year, it's pretty bad. I mean, just by putting your money into boring old VU, 20% in the green. Whereas with IBM, your portfolio would have shrank by 24%. Then again, if we zoom out 5 years, they pretty much offered the same thing. 89% total return for IBM, 85% for VU, and that's because of their most recent sell-off. I think if IBM was still at around 300 whatever a share, then the odds would have been in their favor. 188% in the green with IBM, 86% in the green with the S&P 500. But if we zoom out even more and take a look at the maximum timeline, baking everything in since 2010, then for IBM, it shakes out to 200%, which is pretty good. But the S&P 500, 800%. So I think IBM, it underperforms the market by a pretty wide, significant margin. But then again, it begs the question, what about the next 10 years? Right? What we're looking at right here is the past. The past does not guarantee future results. But completely ignoring the past, I feel like that's a gamble too. I think it shows us a glimpse of their trading pattern and behavior, and especially the way the stock market treats them. I mean, for crying out loud, if you invested in IBM at $116 a share in 2012, by 2022, you essentially would have been flat on your investment. However, in the past like 2 to 3 years, yes, they've been having a wild run up. So I'm not even going to try to pretend like I'm a genie in a bottle that can predict the future. So we don't know what's going to happen in the next 5 or 10 years. But in the short run, it is kind of weird to see. So who is this stock for? I think for IBM, if you're watching this video and you even made it to this point, that means you truly believe in the future of quantum computing. I think that's why most people put their eggs into the IBM basket. Or I suppose if you are a contrarian investor that likes to buy the dip, maybe that's why you're interested. Let me hop on over to their page. Maybe you're thinking about buying IBM because you witnessed that they did flirt with over 300 a share multiple times in the past like 8 to 10 months. And to buy IBM right now at 210, 209 a share, then I can see why you're interested in IBM. However, I think this might be a little harsh. I don't think IBM makes sense as a buy and hold forever because it's not as high quality as Google, Microsoft, or Amazon in the big tech landscape. Like if I had to make a calculated risk in a gamble, I would rather feel confident and be able to sleep well at night in Meta, Google, Amazon, Microsoft, rather than IBM or even say Oracle, if that makes sense. And last but not least, let's go over the cheese rating. Is IBM right now delicious, decent, or moldy cheese? Do I actually want to own them right now? Before I answer that, let me think out loud. So as I was going over their 10K, IBM, they think of their competition as Microsoft, Oracle, SAP, Google, and Amazon. Now, what I'm trying to say is, to be among that crowd, they're all high quality, right? even if you hate IBM, they are high quality. I mean, the fact that they've been around for this long and they always find a way to reinvent themselves and to stay relevant in an ever changing landscape known as tech, I got to give them props where props is due. Then again, at the same time, I cannot ignore the short-term red flag of major companies front-loading memory and storage rather than software, or deciding to upgrade their mainframe from IBM. Because based on what we know, Micron's management is pointing to shortages lasting at least through 2028. Friends and family, right now we're in Q3 of 2026. We have another 2 years of this debacle where SSD and RAM is going to be super expensive because all of these companies are prioritizing their efforts and production to data centers rather than personal or consumer laptops. And SK Hynix, they said that 2027, it's going to be the worst year of this shortage. So the prices right now, you might think it's pretty bad. Like if you were thinking about upgrading your laptop or your computer or even getting an iPad, I mean, we just witnessed Apple, they just slapped on $200, $300 fees on their entire lineup. It's supposed to get worse next year. So my whole thing is this the beginning of a multi-year trend that companies like IBM will have to navigate, where their software and their stuff go on the back burner while companies just continue to buy the fear of trying to get RAM and storage while it's only 3 times as expensive as it was in 2024? Or was this quarter simply a one-off where companies are saying, okay, hold on, we already front-loaded all the SSD and RAM that we needed. Now we should go ahead and prioritize our IT budget back to software. And to be honest with you, I do not know. But I will say this, after sitting with it for a while, a week and a half, I feel as if the concerns surrounding IBM, I think it's short term. When I say short term, I think next 2 years, it might not be so hot for IBM, but I think long term, the next 5 to 10 years, I don't think it'll be too bad. And besides, and once we bake in the next 10 years, if quantum computing really is the next big thing and it's not all a scam, because I know there are some of you out here that believe truly that it's a scam, smoke and mirrors, I think IBM could easily be $500 a share in 10 years, because right now they're the leaders in quantum computing. I think Google and Microsoft, they do have some skin in the game, but I don't think they're prioritizing their efforts like IBM is. So to get it now at 210, I guess it would be considered early, or at least that's what I'm thinking. So for me, I would have to say IBM is decent. I think it's a safer gamble. I mean, it's still a gamble, but I don't think it's as high risk as some other companies that are portrayed on your screen. So I think I would want to buy IBM, but only at the right price. And that's because I see increasing government support and strategic backing for IBM, similar to how I missed the boat with Intel. Because as of right now, Intel and the role that they're playing in the US industrial game, the government will continue to pour billions of dollars into them. And if quantum computing really is the next big thing, that $1 billion that we saw for them to start producing the quantum chips, that's only the beginning. Who knows how much bigger the scale will get in the future. Now, I don't know if IBM is going to have the same upside as Intel. I don't think they will. But also, I'm trying to think very cynically. I don't really want to be optimistic when I think about a potential investment. Then again, I also don't want to underestimate or dismiss what government backing can do for a very strategically important company. So for me, I'll think of IBM as a high yield savings account that costs about $200 that spits out a 3% dividend yield, and any potential share price appreciation is the cherry on top. If I had to buy into them, like I'm saying that I would buy them, but I'm not saying that I am going to buy them. I think that's a huge difference, because at the same time, here's a very interesting fact about IBM. Berkshire Hathaway, when Warren Buffett was younger, at like 78, 85 years old, He actually invested $10.7 billion into IBM in 2011. But after 7 years, I mean, we just saw their stock price chart pretty flat. So by 2018, Berkshire Hathaway, they completely sold out because they just weren't seeing results. And instead, they redirected that capital into one of their biggest winners, Apple. And so my thinking is, this is a really good question for everyone to ask all the time before you jump into anything. Is IBM the best opportunity with the biggest upside in the market right now? And for me to answer that, I mean, I could be wrong. No, I do not think IBM is the best deal right now. So accordingly, I wouldn't throw more than some fun money at him if I had to invest in IBM. I mean, my opinion can change at 5 p.m. once I tune in to their earnings call, but I guess we'll see. Now, please do keep in mind that I'm an idiot. All of this information is wrong and inaccurate. So please do your own research and due diligence so you can formulate an opinion on the company. Just because I made a dedicated deep dive video on the stock, it does not mean that I like it. With that said, if you appreciate this kind of deep dive research and you want to support the channel, I would really appreciate it if you considered joining the Patreon. On the Patreon, you'll get access to my weekly buys and sells. I'm pretty active. On one hand, yes, I am a long-term investor with some positions and holdings, mainly like VU, VTI, SCHD. But with individual stocks, I move in and out pretty frequently. Plus, on Patreon, you get exclusive stock research and analysis that never makes its way on over to YouTube. Now, having said all of that, I love you guys. Stay safe. Good luck in the stock market, and I'll talk to you next time. And as for me, dude, hear me out. I escaped the earthquakes and tsunamis of Japan, and now I live in the deep south, and we're currently faced with a hurricane or tropical storm that's brewing. Such is life. I can never escape or run away from natural disasters. I think it's kind of funny. Anyways, I'll talk to you guys really soon. See ya.